Hi, good afternoon, everyone. My name is Kumar Subramanyam, and I head business development at the Global Investing team. Welcome to this webinar. This is the second webinar that we're doing in this series. The first one was mostly around what to invest in US markets, how do you look at US markets, how do you go about the process, why you need to invest in US markets, some of the benefits of diversification and all that we spoke about. Now, thanks to the journey that we have gone through in terms of global investing, we've seen huge interest in the global investing platform itself in the last 5 months that we've been operational. We've pretty much become India's largest platform for investments in global markets, including US markets. In that context, we thought that we'll continue this investor education series where we talk about different instruments that are available in the global markets, in US markets. In that context, we picked up exchange traded funds, which is a very famous, which is a very popular instrument, I should say, on the platform today because of the benefits that it offers. Exchange traded funds is a relatively new concept in India, but it's been in the US markets prevalent for a long time. So I'll walk you through what an exchange traded fund is, what types of exchange traded funds are typically available, what are some of the benefits. People typically tend to compare an exchange traded fund with a mutual fund and try to understand what the benefits are, what the differences. There's a lot of similarities as well as differences. What similarities, what differences, we'll talk about that. And then we'll talk about how to get started on ETFs on our platform itself. So these are the 3-4 topics I'll cover. I'll probably cover this in the span of 15-20 minutes. And then we will have a question and answer session. So as you have more questions, and the idea is going forward, we will have multiple of these webinars basically to educate you in general about the products that are available in the market. To talk about updates that we have from the global investing team, and also any other questions that you may have along your investing journey. So one of the exciting updates that I have in the new year, something that we launched recently, was a new pricing plan for customers. Initially, we had just 2 pricing plans, which was a basic plan, which was a zero subscription and slightly higher commission plan, and there was a gold plan, which was an annualized subscription based plan and close to zero commissions is what we had there. We recently launched a silver plan, which offers you the benefits of a lower pricing of subscription as well as lower pricing of commissions. You can look it up on our website. When you go there, you'll find the benefits of the silver plan, and that's something that we're seeing a lot of traction in the last couple of weeks that we've launched it. So I thought I'll start with that update. Diving into our topic, exchange traded funds, like a lot of people, like a lot of you may be familiar with it. Think of it as a basket of instruments basically that offers you the benefits of diversification like a mutual fund. At the same time, it allows you to trade it like a stock. So you have a basket of instruments. It could be an equity index, it could be a basket of commodities that are there. So like similar to any mutual fund, this basket gives you the benefits of diversification. But unlike a mutual fund, typically like a stock where you place a limit order or a stop order, or you place a market order to buy, exchange traded fund gives you the benefits of trading like a stock, like real-time price discovery and things like that. It started off with the goal of targeting it to institutional investors, because exchange traded fund works on something, on a concept called as creation units, where basically shares, where the sponsor or the person who's managing the fund, they basically borrow shares and create small slivers of creation units and offer them to institutional investors. But given the traction, it's become extremely popular among retail investors, more recently in Indian markets, but in the US markets for a much longer period of time. And hence, in fact, even on the global investing platform, we see that a lot of investors who are getting into markets for the first time, who don't want to get into stock picking immediately. Obviously, there are a lot of favorites that are there in US markets, but people who want to invest in the index itself. For example, the S&P 500 index grew by close to 30% in 2019. So people who want to be part of the broader base market rally that's happening, we see that ETFs are a platform of choice for them. And within ETFs itself, you have different types, the way these assets are bundled, and we'll go to that. So it's become a really popular choice among retail investors, though it started off with a target market of large institutions. And most exchange traded funds, unlike a mutual fund, where the fund gets actively managed, ETFs are more passively managed. So typically they will track and an underlying instrument. In most cases, it will be an index, let's say the S&P 500 index. And two of the largest traded ETFs globally, not just in the US markets, track the S&P 500 index. So just to give you a sense of the size of scale, for example, the Spider ETF, which is SPY, which tracks the S&P 500, the total assets under management for that exchange traded fund is close to $285 billion, and roughly about $2 billion of the exchange traded fund, $2 billion is roughly about 14,000 crores. So 14,000 crores gets traded in this exchange traded fund on a daily basis. So that is the scale of the exchange traded funds that we are talking about. And you can buy the exchange traded fund, the SPY, for example, which tracks the S&P 500 index. Today, you can buy it at a small, one unit of it at a small price of $300. So you can see that it gives you access to such a large pool. It gives you access to such a large market index at a much smaller price. Now, going on from the definition of ETFs, talking about the type of ETFs that are there, I already mentioned about equity index-based ETFs. You have ETFs which are based on the S&P 500, like the SPY and the VOO. You have indices. You have ETFs which are based on the Nasdaq 100 index. Nasdaq is more oriented towards tech stocks rather than S&P 500, which is across multiple sectors. So you have the ETF called QQQ, which it's called Triple Q, which tracks the Nasdaq 100 stocks very closely. Similarly, apart from equity index-based ETFs, you also have fixed income-based ETFs. These can be based on corporate bonds, based on treasuries, based on municipal income bonds that are there. You have those. You have commodity-based ETFs. So, for example, oil, gold, other metals, agri products, all these commodities. You have. So basically, an ETF is something that can track any underlying asset. So the ETF, the pricing of the ETF itself is very closely linked to the pricing of the underlying asset. You get the benefit of diversification, and you are able to also trade it like a stock. That's the whole advantage. Then you have regional based ETFs. For example, there is a ETF called VTI, which is offered by Vanguard, which tracks the entire which tracks the US market in a very broad based way. It has a coverage of large, medium, and small cap stocks, and roughly about 3,500 stocks are covered in this one ETF. Similarly, you have ETFs which are focused on emerging markets. You have ETFs which are focused on more developed markets like FTSE, like other European markets. You have ETFs which are based on currency products that are there. So the underlying product instruments can be different, but the concept of the ETF remains the same, that it offers you diversification by putting together a basket of these underlying products, and then it offers to you as a trade. It is offered to you as a tradable instrument on the exchange. Typically, ETFs get compared to mutual funds because if you look at the profile of investors who are looking to invest, who want to track the market at a broader level, they have two options. They have the option of going with mutual funds, or they have the option of going with ETFs. There are some 4 or 5. The one similarity, of course, to start with, is that both of them offer you diversification. So whether you want to go for a mutual fund, or you want, depending on the mutual fund's investment strategy, or you want to go for an ETF depending upon the ETF investment goals, both of them will offer you diversification. But there are also some differences between an ETF and exchange traded fund. The first one that comes to my mind, at least, is the expense ratio, which is something that everyone looks at when they invest. So ETFs, for example, roughly have 1/10 the expense ratio of a mutual fund. And this goes back to the attribute that they're more passively managed, whereas mutual funds are more actively managed. So for example, on an average, your ETF in the US market has an expense ratio of anywhere between 0.05% to 0.4%, which is about 5 basis points to 40 basis points. Whereas if you look at mutual funds, the average expense ratio will be anywhere between 60 basis points to 180 basis points. This is the average for most mutual funds in the US markets. So obviously mutual funds are more expensive to invest in. In terms of transparency also, in mutual funds, what happens is you have an NAV that is available to you, the net asset value that's available to you at any point in time, but you're allowed to get in and get out only at the end of the day NAV. Whereas in the case of an ETF, these are products that are traded like a stock live, so you can get in and get out of it. Let's say you pick a you know for some reason that the market is going to be volatile on any given day, and let's say you want to place a limit order and say that if it drops by 1% or 1.5%, then just get into the ETF. So those sort of trading strategies are available with an ETF, which are not typically available with a mutual fund. And then there is also a tax management angle, which is sort of linked to the expense ratio, which is that ETFs are slightly more tax efficient just because of the because of two things. One is the obvious fact that they're more passively managed, so the churn is much lower, and the second is of course the concept of creation units that I explained earlier, where typically the trading happens, the underlying trading of the basket of products happens in a much larger quantity rather than just one stock or two stocks. So the cost of trading comes down significantly in ETF for the sponsorer or the manager of that ETF, and hence they offer you a much more efficient tax structure, ETFs. And there are no minimum investments in the case of an ETF. Like I said, one unit of SPY, which is probably the most famous ETF which tracks the S&P 500, is priced at roughly about $300, and that's all you need to buy a single unit of the ETF. And the big benefit is real-time trading and pricing. So you have, just like stocks, you can trade them intraday, you can place limit orders, you can place stop loss orders and things like that. So that is how the ETFs differentiate themselves from mutual funds. Uh, how do you get started with ETFs? Well, Global Investing is the right platform for that. Just log into Global Investing. It's a very simple process in terms of account setup. You fill in a basic KYC form, you upload your ID proof and address proof. Once your account is approved, you can remit funds and immediately start trading in a lot. I think we have a basket of over 4,000 stocks and ETFs available to you on day one in the case of global investing. Now, let me point out at least some of the most widely traded. We did a little bit of analysis on what are the most widely traded ETFs on the global investing platform. In terms of S&P 500 and large cap, we found that SPY and VOO, these are the two broad ETFs that got traded a lot. In terms of small caps, the symbol is IWM, that got traded a lot. Gold, the Spider ETF, GLD, that was the topmost pick. Nasdaq 100, again the triple Q, QQQ was the symbol of the ETF, and that tracks the Nasdaq 100. That was a fairly famous pick for people who wanted to get exposure more to the technology sector, and people who want to invest in developed markets. For example, today the global investing platform offers you an investment into US markets directly, but let's say you want to get an indirect exposure to European markets, then VEA is the ETF which will give you access to developed markets across the world. So these are some of the pointers in terms of ETFs, what are the benefits, how they compare to a mutual fund, and what are the types of ETFs and how you can start trading. So I think that pretty much covers in terms of whatever I had to lay out in the webinar. I'd be happy to take any questions that you may have at this point. So if I was told that I will be sent these questions through a message, I'm just trying to see if I can get it on the chat window. Just give me a minute. Okay, I don't see any questions here right now, but I'm going to. Yeah, we have one question here. Okay, the question is that please advise if the Nasdaq ETF attracts equity or debt taxation. Well, the ETF will attract equity taxation as far as we understand, and there is a more detailed note on taxation, whether it is related to stocks and ETFs and all that, because we have a lot of questions in terms of how taxation is handled. There are also ETFs, for example, which pay out dividends. So dividend taxation is handled different from capital gains taxations even in the US markets. So there's a fairly detailed note that we will be sharing with all our investors, with all the entire global investing customer base and all of that shortly, which will cover answers to all asset classes, including ETFs, including stock, including future asset classes like fixed income ETFs that we may get in. But as of now, the answer is that to this specific question, the answer is that it will attract equity taxation. So let me wait for some more questions to come in. Okay, so the second question is how to open an account. It's very simple. When you go to the HDFC Sec homepage, which is www.hdfcsec.com, you will see a link to, you will see a dollar symbol which says invest globally. You just click on that, fill in the form from there. There is an open account tab right at the top of it. When you create that, when you click on that, you can create an account. The basic account creation will not take you more than 2 minutes. There are 4 or 5 fields that need to be filled in. You need to do a KYC, so your brokerage account gets opened with our broker partner in the US. That will take you about another 3-4 minutes to fill in the KYC form. You need to upload your documents. There is an ID proof and an address proof that we require. The ID proof is a PAN card. The address proof is an Aadhaar card. In the case of Indian residents, this is what we need. You upload that. Within a period of 24 hours, your account is open. And once you remit the funds from your bank account to the brokerage account, you're ready to trade with ETFs. Okay, I have the next question. It says, can we do the transaction through our normal HDFC security user? I don't see the complete question, but I assume it says HDFC security user ID. No, the HDFC security user ID cannot be used for this, because think of it this way, that you are actually creating an account with a brokerage firm in the US, which means that you are doing a KYC with this brokerage firm. You need to log into this brokerage firm for every transaction that you do, and hence you can't use the same ID. You will be given credentials. Typically you can reuse your email ID as your username. In the case of global investing, you set your own password, and you can use these credentials to log into your account. Okay, there is one more question that I see. It says, can I trade ETF with 3-in-1 account? I think 3-in-1, you're referring to the 3-in-1 account provided again by HDFC Securities in India, whereas the ETFs that are to be traded, and I'm specifically referring to ETFs which are part of the US markets. For you to trade in these ETFs, you need to have a brokerage account over there, so your login credentials will remain separate. So the next question is, can I buy stocks also? Yes, obviously you can. With the same platform that is available, once you log into global investing, we have on offer over 4,000 stocks and ETFs on day one for you. We don't have any limit. Basically, all liquid stocks on NASDAQ and NYSE are available to you on day one to start trading. So stocks are available, yes. Okay, so I think we are done with the questions. We've exhausted the list of questions for this webinar. While it was short, I hope you found it useful. As I mentioned, we will continue the series of webinar where it is more of an education platform where we share any new products, existing products, what are the features, what are the benefits. That is something that we'll continue to share. For example, there's an interesting feature called fractional shares that are available. Hopefully we'll cover that in the next webinar, and we'll continue to educate you through this. So do visit hdfcsec.com/global investing and start your global investment journey. Thanks.